Hello, everyone. Welcome to Real Estate Right Now. We talk about real estate matters that matter to you. My name is Jay Izzo, and we're doing a little bit different show today. We're talking about real estate headlines going on this week, something that we don't normally do, and I'm doing this solo. And so this is where I'm asking for your involvement. Would like for you, I've got questions lined up for today, and would like you to chime in. And I know if you're listening to this by podcast, you're saying I can't do that. You're absolutely right. You can't do that. But nonetheless, you can always reach out to me, jay@lindacraft.com. That's JAY at LINDACRAFT.com. If you're joining us live, whether that's at Facebook, LinkedIn, or wherever you're at, as I ask the questions, I'd love to have you chime in, and we'll give you some a shout out here on the show and allow you to participate. Here are some of the facts. If you've been reading real estate headlines this week, you've probably seen stories that seem to contradict each other. One outlet says inventory is at a crisis low. Another says inventory is at a decade high. One source says that the quote unquote lock-in effect is freezing the market. Another says it's fading fast. The fact of the matter is, two things can absolutely be factual. It's just different ways at looking at things, and largely, where you are at in the country. So if the problem with media outlets are, if a media outlet grabs a particular headline from somebody, what they do is they generalize that across an entire population, and that simply is not accurate. So we're going to talk about both sides of the coin today, and some of the top headlines of the day. And we're going to try to sort it all out. I've got about 5 segments, and I've got data sources. And by the way, if you want these data sources of where I got my data from, please reach out to me at jay@lindacraft.com. And I'm more than happy to give you my sources, because the numbers do appear to conflict with each other. So let's get into it, right? So the first one is mortgage rates. Where are they really? Where are mortgage rates really? Well, according to Freddie Mac Primary Mortgage Survey, as of March 5th of 2026, the 30-year fixed average is somewhere around 6%, hovering near its lowest level since 2022. Zillow, as of March 10th of 2026, the average 30-year purchase rate they quote is at 5.87%. 15-year fixed is at 5.5%. If you're in the refi market, right, which some of you may be, and there's a reason why there may be, we'll talk about that here a little bit. The 30-year refi market rate, not all that great. 6.4%, according to Zillow, March 10th. 1 year ago, which is interesting, which is March of 2025, the refi rate was 6.63. 2 years ago was 6.88. I'm sorry, the mortgage rates were 6.63, and 2 years ago was 6.88. That was the mortgage rates we were getting at the time. We were falling below 7. Now we're hovering around 6, occasionally get below 6. Some lenders are quoting qualified borrowers as low as high as in the 5% range. So the 30-year fixed has been above 6% continuously since about 2022 until really, really recently. And this comes again from Freddie Mac, Zillow as well. So what are the things moving the rates right now? The February inflation report just came in, and the CPI was plus 2.8 year over year, 3.1% year over year. That's the index that talks about where our inflation is. This is the number that determines whether the Federal Reserve can justify cutting rates mid-year or whether they stay put. Now, remember, anytime that the Fed cuts rates, that does not directly affect your mortgage rates. It is a short-term, it's for short-term loans. So when the Fed cuts the rate, yes, your car is cheaper, but typically what we find is when the Fed lowers rates, and by the way, we'll have a hard time ever seeing this in mortgage rates, but what will happen is mortgage rates will actually go up. So every time the Fed lowers the rate, mortgage rates actually jump a little bit. and then they settle back down. So, and this is kind of a connection that people don't really see. I've had guests on this show talk about, that the mortgage rates actually, when the Fed cuts the rates actually go up. And this is because the bond yield, right? The bonds are what drive the mortgage rate. So there's another issue that's affecting mortgage rates right now here. It's been talked about a lot. We're participating in part of a war here, and that's pushed oil prices up this week. Higher oil feeds inflation fears. So you'll notice that people panic about higher gas prices. Well, it's almost an irrational fear in the sense it's almost phobic, because what happens is we fear, the oil rates are going to go up, meaning that they're never going to come back down, but that's never been the case. Inflation fears, what happens is push the bond yields up. Bond yields drive mortgage rates. So, and this is a connection that most home buyers, and I would say sellers too, just don't see. So what's the Fed's current position right now? So the Fed held its rate steady at the first meeting in 2026. 3 cuts happened in late 2025. The central bank is now in what they call a wait and see mode. The consensus range for 30-year mortgages through 2026 is 5.75 to 6.6%, depending on the inflation trajectory. I said inflammation because I'm not sure. I think it's almost related, right? What does this mean practically to you? What this means practically to you is that rates today are meaningfully lower than they were 12 months ago, which is great. Whether they go lower from here depends on data, not predictions. Jumbo loan rates have actually stayed below conforming rates in some markets. So if it's a bigger home that's jumbo, that they've actually stayed below the conforming rates, interestingly enough, creating unusual deals for higher end buyers, right? So if you're an upper end buyer, actually things look pretty good for you. It's that lower rate that is questionable. So here's the first series of questions. I'd love to have you chime in and answer that. And here's the first question I have for you. Have you seen a rate below 6% quoted to you this week? And from which lender and what type of loan? I would love to have your response. Have you seen a rate below 6% quoted to you this week? From which lender and what type of loan? That's the first question. Second question I have, that's related to this. If rates drop to 5.5% this spring, does that change your decision to buy, sell, or refinance or not? Okay, say it again. If rates drop below 5.5% this spring, does that change your decision to buy, sell, or refinance or not? That's an interesting question. And then the third question, are you watching the Fed announcements, or do you just check the Zillow or bank rate number and go from there? That's what I'd like to hear from you. So feel free to chime in with those answers to those questions. I'd love to see what you have. The next headline is the inventory story. Depending on the news source, you're going to see a lot of things on the inventory. Are we up? Are we down? Are we staying the same? A lot of people don't appear to not have a clue, or they make a very hard stance on it. Well, I just want to say this. Here's the answer to that. It just depends on where you live. Because the reason why you could say, well, inventories are high, well, it just depends on where you live. If you say inventories are low, well, it just depends on where you live. So we're going to look at some of the conflicting data that is most visible, and so that we can understand that both sides of the story are factually true. It's just that they're true in different zip codes. So let's take a look at the national picture. According to Redfin, in January 26, there were 1,685,754 homes for sales nationally. That's up 1.5% year over year. Now, in February 2026, Realtor.com and Resi Club said active inventory was up 7.9% this year over year. Now, the national inventory is still approximately 17% below pre-pandemic 2019 levels nationally, okay? But that may not be true in your area. So let's be very, very careful about how we say that, because again, putting a blanket over the entire nation makes it sound like, oh, everything is down. Well, that's not true. Just depends on where you're at. That may be. So months of median days on market are 66 days nationally as of January 2026. That's up 7 days year over year. Again, depending on your area. Months of supply nationally, there's 4 months of supply. Generally, when we see 4 months of supply, that's generally considered a balanced market threshold. So that's pretty well balanced, which means it sounds pretty normal, right? 2025, we saw inventory rise 12.5% nationally year over year. And the experts, don't know who always they are, but the experts project another 8.9% gain in 2026. And we'll see if that's really true or not. My guess is that I think it will increase, is my guess, just based on the analytics and the statistics and what we're seeing and the trends, that probably may be pretty close to an almost 9%. So where's inventory high at or above pre-pandemic levels? So let's talk about where they are high. As of the end of 2026, there are 9 states that are above their pre-pandemic 2019 active inventory levels. So if you live in Arizona, Colorado, Florida, Idaho, Nebraska, Tennessee, Texas, Utah, Washington, these 9 states are above the pre-2019 active inventory levels. So for instance, Texas is plus 48% above the 2019 inventory levels. Florida is 42% above. Idaho's 38% above. Austin, Texas has 114% more sellers than buyers in late 2025, which is the widest gap across the 50 largest metros. San Antonio was 106% more sellers than buyers. Nashville was 104%. Fort Lauderdale was 102%. So what we kind of found is that the Sun Belt and the Mountain West states do lead this recovery due to heavy new construction and cooling demand after pandemic era price surges. So we do see areas of the country that are have got a lot of inventory, which gives buyers a lot more leverage in the market. So if you're living in Arizona, Colorado, Florida, Idaho, Nebraska, Tennessee, Texas, Utah, Washington, yeah, you may have, and by the way, that can also be dependent on the city. So, you have to look at this from different ways of viewing this. You can't make a blanket statement again that says, well, the whole state maybe is at these levels. That may not be true. There are certain areas that are just better than others. So let's talk about where inventories are still really, really, really tight. So parts of the Northeast and parts of the Midwest, I said Nebraska was just fine. By the way, that's where I come from. But there are parts of the Midwest that are significantly undersupplied, often 40 to 50% below 2019 levels. Here's some of the states that are probably below: New Jersey, Connecticut, Massachusetts, still highly competitive, very limited selection. Chicago and the Rust Belt cities also have among the smallest inventory increases in the country. Hartford, Connecticut, Albany, New York, Cleveland, Ohio, still appreciating, very tight supply. And this comes from Zillow, and they still identify a 17% inventory shortfall nationally, not locally, compared to pre-pandemic times. Sources are from CalcLogix, Housing Inventory Forecast, Newsweek, Reventure, etc. So there is some conflicting data out there, and you have to just know your area here. At the Triangle, I think we're pretty normal here in the Research Triangle Park. Inventory seems to be just about right. There are some stellar concessions in certain places, but we seem to be pretty balanced here in the North Carolina markets for the most part. So the question then becomes, why are the national numbers so misleading? Well, the national numbers the national average hides a market that has split into two completely different realities. The Sun Belt and Mountain West, by the way, has buyer's market in many of the areas. Decade high inventory, price reductions, seller concessions. Some homes are sitting for months, right? The Northeast and parts of the Midwest are still seeing a seller's market in many areas. Tight inventory, modest price appreciation, competition is still present. So a buyer in Austin, Texas, and a buyer in Hartford, Connecticut are living in fundamentally different housing markets right now. And even though the national headlines describe it's the same for both of them, it just simply is not factually true. Depending on where you live, largely depends on the market. So if you're listening to national news talking about what the housing market is or is not, it doesn't account for individual differences in individual markets. And so I encourage you, as you're watching the show, not to buy into the national averages, because the national averages are not telling the whole story. It is a global scoreboard that may be very different in your area. What you need to do is you need to look at your area, find and by the way, it's easy enough to do. Generally, you can now AI it and find what's happening locally in your area. But the other thing I would say is find a qualified real estate professional who does the statistics. I know that the Linda Craft team does this regularly for folks. What's really happening on our market? And in we even have an person who's got an economics degree that does these type of statistics on a regular basis. He just loves that type of thing. So new listing trends, and I want to express a caution here. Nationally, in January 2026, there was 449,251 listings, which, according to Redfin, it was down 7.5% year over year. Again, nationally, may be different in your area. Now, according to Housing Wire, as of January 16th, new listings totaled 50,303, which was up 29% week over week and 9.7% year over year, which has been described as one of the strongest early season listing weeks since before the pandemic. Conflicting data again. So again, this is where you have to know your market. Florida, which led the Sun Belt in inventory surges, is now seeing an active inventory edge, down slightly year over year, about 4% down, as of March 2026, according to Resi Club. So the pace of inventory growth nationally seems to be deaccelerating. That doesn't mean inventory is low. It just means that the rate of growth is slowing. So let's put that into perspective, right? This doesn't mean we have a low inventory. It just means that our growth rate has kind of slowed down a little bit. So we had a strong January, February. Not sure what March is going to produce here. So here's my 3 questions for you that I'd love to have you answer. Jump in. Where are you located, and what does your local inventory look like right now? And is it more like Texas, or is it more like Connecticut, or is it somewhere in between? I'd love to hear your responses to that. If you're in the Sun Belt or in a Sun Belt market with a high inventory, are you seeing price cuts? And how significant are those price cuts? And are sellers actually negotiating? So I would love to have you comment on that wherever you're living. And then the third question is, national headlines suggest or are saying, quite frankly, inventory is tight. Your zip code might say something different. Which do you trust in making a decision? National data or what you see with your own eyes? So those are the 3 questions. I'd love to get your comments. Certainly feel free to email me at j@lindacraft.com, and would love to see your answers there and interact with you there as well. This brings us to a third headline, and that's called the rate lock-in effect. The data has shifted. So what is the rate lock-in effect? That's the idea that homeowners will, with ultra-low pandemic era rates, refuse to sell because they would be trading a 3% mortgage for a 6% mortgage, right? And which has been dominant story in the housing for the last 3 years. The data, however, says it's changing, and here's what the numbers actually show. And I found this to be extraordinarily interesting because I've heard real estate agents say, "Well, people aren't going to trade in a 3% mortgage; they aren't trading." Well, yes and no. So let me give you this. Source comes from the Redfin analysis of Federal Housing Financial Agency National Mortgage Database. Q3 is the most recent period of which data we have available. So folks at or above 6% mortgages, 21.2 of all outstanding U.S. mortgages are 6% or above. 21.2%. Hold on to that number because this is the number that might surprise you. Do you have any idea what the percentage is below 3%? Outstanding mortgages left in this country? 20%. Ooh. So now we're starting to see that we've got actually a higher percentage of people who've got a mortgage above 6% than we did with people who have a mortgage below 3% or below. So that means there is a market shift here. And the idea that, 70 or 80% or even 50% of people still are holding on to 3% mortgages, that's just not factual. Only 1/5, 1 out of 5 are holding on to that 3% mortgage. So what is everybody else doing? Well, at or below 4%, 51.5% of all outstanding mortgages are below 4%. 68.6 are below 5%. So 5, 4, 3, right? 10% are between 5 and 5.99. 17% are between 4 and 4.99. And 32.1% are between 3 and 4%. So we do see people that 1/3 is basically below between 3 and 3.99, which is still a great rate, right? I mean, we still felt that was great money. It was almost free money, as a matter of fact. So what's this data telling us? So we're starting to see the crossover, meaning for the first time since 2020, more homeowners have a mortgage rate above 6% than below 3%. That crossover actually happened in the second quarter of 2025, continued into the third quarter of 2025. So this is a structural shift. This isn't a blip, right? Because once you get rid of that 3% mortgage, you're not getting it back. So we're seeing people actually give up that 3% mortgage, right? There's not as many as we thought. Yeah, it's still a pretty significant number, right? 20%. But we're seeing people actually get out of that 3% and move on from it because they want to either downsize, upsize, change houses, change locations. Maybe it's due to relocation or a number of other factors. So those are some of the reasons. The idea of the lock-in effect, locking at 3%, I would suggest that it's fading. It's not gone, certainly. It's just more fading. So 68.6% of owners still have rates below 5%. That's fact. And the typical homeowner would see their monthly mortgage payments rise by nearly $1,000 if they sold and bought at today's median price and rates. The financial reality hasn't really disappeared for many, many people. But I think, in the real estate community, there was a lot of blame that too many people were at 3%. Not so much. So really, it's below that 5% threshold that is really the larger event. But here's something interesting that we're seeing. We're seeing that life events are now overriding rates. Let me say that again. Life events are now overriding rates. So more and more homeowners right now are deciding the financial cost of moving is worth it. That's an emotional decision. So now I'm going to speak as a psychological professional and say to you that here's the thing. We make our decisions emotionally. So what's happening is as life events change, or we go, you know what? I'm just going to bite the bullet and I'm going to I'm going to purchase the home because it's the right house. It's the one I've looked at. It could be because of a divorce. It could be job relocation, family changes, retirement. The fact of the matter is life doesn't wait for mortgage rates. End of story. Life doesn't wait for mortgage rates. If you got to go, you got to go. If you're making a change, you have a significant life event, it's going to alter your decision-making process. And as much as you may want to hold on to that lower rate, those life decisions actually change it. So the life events are far more important than the mortgage rate is right now. And you may be in that position where your life events are such that you're causing a change. In fact, Redfin's chief economist noted that life events are starting to outweigh the financial benefit of clinging to a rock bottom mortgage rate. So they're not holding on to that locked in. What about the wealth cushion factor? And you go, what? Okay, well, listen, the Federal Reserve data through quarter three, which is 2025, which is the latest data we have, U.S. household and nonprofit net worth rose by $181.6 trillion. Say that again. Net household and nonprofit net worth rose to $181.6 trillion. Huge number, huge number. Homeowner equity in real estate, 48.04 trillion. Many homeowners are not just holding a low rate, they're holding massive equity. So that equity in these homes gives them a lot of flexibility to wait it out. So some people are blaming the mortgage rates, but in fact, so many of these people have so much home equity, they got the flexibility to wait or to move if they want to. They don't have to move if they don't want to move because of the equity they have. Now, listen, there are some dangers in that, right? Right? Because, housing markets are like the stock market. You just, you never know what the market could do at any given time, and depending on events that happen. But when you have a lot of equity, it does give you some flexibility for sure. One of the statistics was that 1 in 6 still lock in by choice. So according to a Redfin survey at the end of the year that was done by Ipsos, found that 16% of U.S. homeowners are explicitly staying put because they don't want to give up their low rate. So of that 20% that we saw, right, so basically 3/4 of them, maybe a little bit more, are holding on because they really don't want to give up that rate. And I know people like that are like, you know what, I really don't want to give up the rate, right? That's a real number, but it's not the majority it once was. So I think it's important for us to note that it's not the majority anymore of homeowners who are holding on to the rate. So the idea that the market is stalled because of people with the 3% or lower interest rate is just not factual at all. So here's my 3 questions for you. If you're a homeowner with a rate under 4%, what would it actually take for you to list your home and move? Interesting question. Is it a rate number? Is it a life event? Or is there something else? I'd love to see your comments or hear from you. Again, jay@lindacraft.com. See what your thoughts are on that. But second question is, and this is for agents and lenders who are listening right now, are you seeing more sellers come to the market in 2026 than in 2024 or 2025? Interesting question. And what are they saying that's driving their decision? I would be really, if you're an agent or you're a lender, I would love to hear what you're experiencing right now in the market. And then the third question, does the data surprise you that 21% of mortgages are now above 6%? Does that change how you think about the locked in story? So again, I would love to hear comment for those who are watching live, and thank you for all those who are. And for those of you who may be listening, I would really love to get your responses to some of the questions. Again, just email me. I would love to interact with you on that. The next part is kind of interesting because the next headline, because it's fairly controversial. And I have wrestled with this headline over and over and over again, and not sure how to almost respond to it. And that is, AI versus real estate brokers, which is really, really interesting. Now, let's keep in mind that real estate is in multiple, I would say, multiple markets. We can generalize it down. There's residential and commercial. I mean, we can generalize that. So in February 2026, the biggest commercial real estate brokerage firms in the world got hit with a stock sell-off that wiped out billions in market cap. I don't know if you knew that. Not because their earnings were bad, but because investors decided AI was going to fundamentally disrupt their business model. Here's what happened. I'm going to explain it and what it means for every real estate professional. So let's start with the commercial. And by the way, there seems to be a following pattern between commercial and real estate one way or another. Commercial does something, and oftentimes real estate will follow something similar. Residential does something, oftentimes commercial will follow. So there's this interplay between commercial and real estate. So on February 11th, 2026, Cushman & Wakefield dropped 14%, Newmark dropped 13.4%. CB Richard Ellis dropped 12%, JLL dropped 12%, Colliers dropped 11%. The fact of the matter is, what we're seeing is there was in one day, it was the largest, biggest single day drop since 2020 in the commercial real estate market. So CB Richard Ellis reported quarter four earnings 2025, profit of 818 million, which was up 15% year over year. The financials were strong, yet the stock sold anyway. And it's because they're really concerned about AI involvement and what's really the role in commercial real estate. Bloomberg characterized the move as an AI scare trade. So investors repricing future disruption risk, not based on current business performance. Sources were from BizNow, Bloomberg, CommercialObserver.com, and Yahoo Finance. So here's the question. What AI actually threatens the real estate services? So market research and analytics, lease clause extraction, lead filtering, sales data count compilation, marketing material generation, initial deal term drafting. These are all tasks AI tools are already performing faster and at lower cost than humans. I know this is going to upset my real estate colleagues, but the fact of the matter is AI is getting more and more involved into real estate. And so it's doing things faster. It's doing pieces that we thought were fundamentally important to us that are no longer as important as they once were. So AI is more and more involved. And by the way, we see this all over the place where AI is becoming more and more involved in the real estate transactions. So what does that mean? So now, complex transaction negotiations, client relationship management, proprietary pricing intelligence, navigating contested deals, local market judgment developed over years of experience. The thing is that if it's complex, it's still AI is really, really involved in helping make those decisions. So that's the commercial side. So the commercial side, is certainly dealing with some issues here because of the AI scare. And I almost can say that, with this happening on Wall Street and that big sell-off, even though companies were profitable, I think there is a little AI phobia, right? And when I say AI phobia, what I'm saying here is that I think there's an irrational fear that AI is somehow going to completely take over the real estate industry. That's not really possible, right? I do think that AI is more and more involved, but it can't completely take over the industry because we're not going to be able to. There's just functions that have to be dealt with humans, and there's legal implications here too. Whereas in North Carolina have the North Carolina real estate commission, and it's still humans involved with these decisions. And people are not going to be able to sue AI, but as an agent or a broker, if you're using AI inappropriately, you may find yourself in some hot water. So we have to be very, very careful with this. So what about the residential side? So the same questions now that we have on the commercial side, we're starting to ask on the residential side. And the National Association of Realtors Commission structure was already, if you recall, in 2024, was upended by a settlement. AI is now adding a second wave of questions. What tasks can be automated, and what is the irreplaceable value of a human agent in a transaction? And it's a really good question, by the way. Ryan Serhant on CNBC this week framed it this way: if I can use technology to sell property to anyone, anywhere, on any device at any time, I will take that opportunity. His position is to use AI as a tool, not fear it as a threat. So now the question is that, is AI going to become could it become an MLS? And the answer is that's very possible, that AI could be an MLS. And that, we are getting to a point where we may see people being able to sell homes through AI. Very interesting question. And it's one, if you're an agent, either I could see you being afraid of that or concerned about that. As a consumer, you may be going, I kind of like this, right? I think, being able to maybe do something through AI is becoming a bigger part of the conversation. And certainly there has to be more conversations about that. I know that people want to hold on to the fact that AI is not going to take away jobs. I will just say this straight out. That simply is not true. We're seeing it happen. AI is replacing people. Now, will it create other jobs? Yes, but are people willing to pivot to those jobs? That's the question. But it is taking away certain functions and jobs. People are able to work without assistance because of AI. People are able to do a lot more things to streamline their business through AI so that smaller teams can compete well with larger teams because they don't have the overhead because they're using AI in a way that's very sophisticated. So it's a really interesting question. Now, this is where I want to get into the flip side of the AI story. So the same AI build out that is threatening brokerage fee models is creating massive demand for data centers. One of the hottest commercial real estate categories in the market right now, Iron Mountain, IRM, was a top performing REIT, real estate investment, in March 2026, up over 23% month to date. Blackstone is reportedly launching a public company specifically to acquire AI data centers. The technology disrupting one category of real estate is driving record demand in another. Really, really interesting of what we're doing here. So here's my 3 questions for you. For agents who are listening, what is one thing you do in a transaction that you believe AI genuinely cannot replace? That's the first question. What's your answer when a client asks you that question? Right, really interesting. Here's the second question. If AI can find, underwrite, and negotiate a home purchase, what role does the human agent play? And is that worth what you're charging? It's an interesting question. And it's one that's going to come up over and over again. And I don't think we can ignore it, right? I'm not trying to be a Debbie Downer here at all, but it is a question that we have to, I believe in the real estate industry, have to take a really hard look at. If listen, if AI can find, underwrite, and negotiate the home purchase, right? Where are we at in terms of what we charge? It's a really good question. For investors, are you looking at data center REITs or AI infrastructure real estate? Or does that feel too far removed from traditional real estate investing? So it's really kind of an interesting question, really, for investors. But I think we just have to admit that AI is becoming more and more a part of our world. We're going to have to ask these questions. We're going to have to get answers to these questions. We're going to have to uh, look at these questions and answer for ourselves. Where do we fit? What's our role? Where's our value? What's the value to a buyer or a seller in what we do, and distinguish ourselves and 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 understand what that is, because AI is replacing a lot of things, and we just have to be honest with ourselves with that. Fifth headline: where's the market moving on the two-speed divide? The single most important framework for understanding real estate in 2026 is this: there is no single national housing market. I said that in the first segment. I'm saying that here in the fifth one. There are at least two markets operating at the same time, and oftentimes moving in opposite directions. So let's talk about some of the data. I've already talked about some of this, but as I said in the first segment, inventory in places like Texas, Florida, Arizona, Colorado, Utah, Tennessee, Idaho, etc., their inventory is above pre-pandemic levels, right? If you live in the Raleigh area, listings are up 54.5% year over year as of July 2025. By the way, that's the largest increase of any major metro area, according to Homes.com data. I'll say that again. Listings are up 54.5% year over year as of July 2025. That's the largest increase of any major metro area in the United States. So we have a lot of inventory on our market. It's the largest increase in the U.S. If you're in Las Vegas, Miami, Atlanta, inventory gains above 35% year over year. So again, think about this. Vegas has got high inventory. So does Miami and Atlanta at gains above 35%. Builders are offering rate buy downs, price cuts, closing cost credits in these markets because they got to move the unsold spec inventory, right? So what caused all this? Well, pandemic era migration has slowed. Prices stretched beyond local income levels, and new construction kept coming. So we've got a lot of forces at work, right? So if you recall, during the pandemic, there were multiple offers and prices were jumping way, way above. And people were buying houses as is because of the rates. And then at the same time, new construction was coming, and they kept building new construction homes. And so all this pandemic migration of, getting the house now, that's all slowed down, which has created a lot more inventory in some of these areas. Now, again, some areas like Hartford, Connecticut, you're not seeing that. I get that. So let's talk about the Northeast and Midwest inventory, with the exception of Nebraska. By the way, many of these places you're still seeing 40 to 50% below 2019 pandemic levels. That's, again, Hartford, Albany, Cleveland, and Chicago. Columbus, Indianapolis, Kansas City are showing growth driven by affordability and proximity to universities, interestingly enough. Zillow ranks Hartford, Connecticut as the number one hottest housing market for 2026. Inventory is down 63%, over 66% of homes selling above list price. May not be happening in your area. That's happening in Hartford, Connecticut. Rents rising in these tight markets as apartment construction slows. So this is the other thing. If you're a renter and you're in these areas that you have tight markets, we've also seen a slowing in apartment construction. Well, whenever you have slowing in apartment construction, what happens is you start to see your apartment rents go up, because why? Supply and demand, right? And so all of this is a trickle down effect, and nobody wants to hear that, but it really is true. Everything trickles into everything else, right? So there's such a trickle down from all this stuff. It's really quite amazing. So the national price picture, median home sales price as of January 2026, 423,000 $29. That's up 1.1% year over year, according to Redfin. JP Morgan Global Research forecast home prices, they're suggesting that home prices are going to stall right around 0% nationally in 2026. Redfin forecasts maybe plus 1% median price nationally. Again, it may be different in your area. Realtor.com's forecast, they're being a little bit more optimistic. They're saying that we're looking at a 2.2% increase nationally. Now, I will say that JP Morgan notes that prices falling mostly along the West Coast and Sunbelt still are, but yet still rising in the Northeast and Midwest. So they're taking a more, what I would say, selective view where they're saying, okay, on the West Coast and the Sunbelt, we're going to see prices drop. But in the Northeast and parts of the Midwest, we're going to see prices increase. So it's really quite interesting. And it could be because of a number of reasons. One's the tight market. But if you're in the Midwest, you may see that the rising there simply because the inventories are so low. So again, supply and demand, it all trickles down. 21% of the homes in the United States sold above list price in 2026. I'll say that again. 21%, that's 1/5 of homes in the United States sold above list price in 2026. Now that's down 1.5 points year over year. Yeah, see, so again, the statistics can be a little bit deceiving depending on how you look at it. 17.2% of active listings had price drops in 2026. That's up 16% from a year prior. So we're seeing seller concessions in some of these areas for sure, especially where there's heavier inventories. When you've got a lot of inventory, in order to be competitive, you as a seller are going to have a price drop. And so that's why we're seeing nationally, there's a 17.2% price drops, meaning sellers are lowering their prices to sell. But it could be much higher in some areas. It could be much lower in some areas, depending on where you're at. So, you got to be really, really careful in your area. So, few things here. For the first time since 2022, buyers are projected to spend less than 30% of their income on housing payments nationally. That's according to Realtor.com forecast. That's good news, right? Because that means that they have more money. They're making more money, which means that they're not using as much disposable income as they may have in the past to get into a home. Zillow data, share of income needed for a mortgage fell to 32.6% as of late 2025. Again, that's the lowest since 2022. So again, we're seeing people, even where the mortgage rates are, we're seeing people not have to use as much of their disposable income to get into a house. Monthly mortgage payments are down more than $100 year over year. Nearly 2/3, 60.2% of home buyers in 2025 received a discount off the list price. It's according to the Redfin MLS analysis. The typical cut was 7.9%, and the original list price down the largest since 2012. So we're seeing almost 8% concessions nationally, and that's the largest cut in list price since 2012. So here's the questions I have for you on this. Are you in the Sunbelt market, Northeast, maybe West Coast, Midwest market? Based on today's data, do you feel like your local market matches the national headlines that you're reading? And what's the differences? I think that's interesting. If you're a buyer and the data says Sunbelt markets are now buyer friendly, does that change your thinking about where to buy, or is location non-negotiable for you? Interesting question. Third question, buyers got discounts of nearly 8% below list price in 2025. If you bought in 2025, did you negotiate a cut? And again, depending where you are, if you didn't, do you wish you'd pushed harder? Great question. All right, so we've almost done an hour of real estate facts, no filler. Let me give you 5 things to take home with you from today's show. Number one, mortgage rates are sitting around 6%. That's the lowest since 2022. Whether they go lower depends on all sorts of data, the Fed, the CPI data. Watch both. Number two, the inventory story is not one story. Depending on where you live, you may have more selection than you've seen in a decade. If you're somewhere else, it's still really tight from an inventory standpoint. So don't rely on the national headlines. They do not describe your local market. All right. Don't let the national headlines fool you. Your market may be different. You cannot trust because the media in this aspect, because the media is not talking about your area specifically. They're giving you a global view. It's a blanket statement. It's never true. Number three, the rate lock-in is loosening for the first time. More Americans have mortgages above 6% than they have below 3%, which is really quite interesting. And this means that the pandemic era freeze is got a cracks and it's starting to leak. But 69% of homeowners still have rates below 5%. So it's not over. It's just subtly changing. Number four, AI hit commercial real estate stocks hard in February, not because of earnings were bad, but because investors are rethinking and repricing their future. I think every real estate professional needs a clear, honest answer for what they do that AI cannot do. And I think you as a real estate professional really need to dig into this question. You can't ignore it. You can't avoid it. You can't run from it. You're not going to fight it. That's not going to happen. So you really need to do some soul searching and some digging. And I believe these have to be roundtable discussions of what is it that you do that AI cannot do? And because that's very real. And I think you have to have that discussion. And I think there has to be some talk about that because the reality is AI is affecting every industry across the board. Real estate is not immune to it. And then finally, just as a reminder, the market's not national. Find the data for your market. The zip code matters more than the national headline. So here's what I would ask you to do this week. Go look up your specific county or metro area, wherever you use. You can use a number of things, redfinrealtor.com. There's tons of things out there. Don't look at the national number. Look at active listings, days on market, sale to list price ratio. That's your market. That's what matters. If you don't have the time to do this or you can't access through AI or you want some help, go find a local real estate professional who really is into it. And I mean, right here, if you're asking about Linda Kraft's team, Steve Kruger, who's a senior listing and buyers expert, loves running these economic numbers. So feel free to reach out to Steve. I'm here. He'd be happy to do that for you because that's your market. That's what you got to be concerned with. Or if you're moving to another market, be concerned with what that market's doing. Just because you are looking at your market and saying, okay, this is what I can do. Now that's important because if you do have to make a move due to relocation, you have to look at, okay, well, do I need to sell? How much am I going to get? But then look at the other market. And I'll give you a prime example. This is a real example from a client here and a friend of mine who wife took a job in Silicon Valley in California, lives here in the Raleigh area, Research Triangle Park area. They had just purchased a home and his wife got this tremendous job at this large company. And so they were trying to decide if they were going to move to California. I mean, they have to move to California, but they were deciding whether they should rent or they should buy. So the question then becomes for them, which one should we do? Well, when they calculated what the rent cost was versus the purchase cost was, it really worked out that they felt like they needed to buy, but they were looking at whether they should sell their home. Now, remember, they've only been in that home a couple of years. So now the idea that they would sell their home really didn't make sense because there was no equity in the home at that point. So they held on to their home. are getting a new home, right, that they're going to move into, a townhome in California. Costs a lot of money, by the way, but they had to look at both markets. And I think for you as somebody who is looking at selling and buying something else, or just out there buying, look at your markets. That's going to be so imperative to you to be successful, so that you can get the right house for the right price. And also remember, depending on the market, you may have more negotiating room than others. And if you go to another market, you may be paying overpriced just to get into a home. It's just market dependent. So look at your markets locally. Look at the markets you're planning to go to. Get the full details of that market. Don't look at the national numbers. You know what? Listen, you guys had a lot of choices. You chose us. Thanks for doing that today. Thanks for joining me. This is a different show that we've never done before, where I talked about real estate headlines. I've enjoyed my time with you. I hope you have. Please reach out to me if there's a type of show that you like to see us do here at Real Estate Right Now. You can just reach out to me at jay@lindacraft.com. That's JAY@LINDACRAFT.com. Give us a thumbs up on YouTube. Wherever you're listening to the show via podcast, give us a positive 5-star review. As I say to you all over the world, you know what that is, right? It's ciao, everybody.